Well, aloha. It's Friday. Once again, this is Jamie Barber with Jamie Barber Homes saying aloha. So here we are. It's Friday. And in Southern California, the weather's actually been pretty good this week. But coming up to this weekend, it's going to get warm again. So expect at least the next 3 or 4 days. I think it's going to be hot till Tuesday. So, speaking of heat, the Fed raised its interest rates again this week. They had their meeting and they decided to, they're trying to control inflation. So, in doing that, they raised the interest rate 0.75% again. So, they've done that a few times this year, really trying to get a control of the inflation rate. The numbers were pretty high when they were released last week. So, what does that mean to you? How's it affecting you? So, and we'll see how it affects the mortgages. Right now, the federal has lifted the key interest rate several times this year, which I told you about. And Americans have seen the effect on both sides of the household ledger. Savers benefit from higher yields, but borrowers pay more. So let's look at how it works. Credit cards. Now, your credit card rates are closely linked to the Fed's actions. So consumers with revolving credit can expect to see those rates rise, usually within 1 or 2 billing cycles. The average credit card rate was 18.1% as of September 14th last week. That was according to bankrate.com, up from around 16% in March when the Fed began this series of rate increases. With the frequency of Federal Reserve rate hikes this year, it will be a drumbeat of higher rates for cardholders every couple of statement cycles. And that was from Greg McBride, the chief financial analyst at Bankrate. Car loans. Let's look at what's going to happen to car loans. Car loans are expected to climb, but those increases continue to be overshadowed by the rising cost of buying a vehicle anyway, the price you pay and the price you pay for filling it with gas. Car loans tend to track the 5-year Treasury note, which is influenced by the Fed's key rate. But that's not the only factor that determines how much you'll pay. A borrower's credit history, the type of vehicle, loan term, down payment are all baked into the rate of calculation. The average interest rates on a new car loan was 5% in the second quarter, according to Edmunds, up from 4.4% in the same period last year. Who would have thought? Now, mortgages. Rates on the 30-year fixed mortgages don't move in tandem with the Fed's benchmark rate, but instead track the yield on 10-year Treasury bonds, which are influenced by a variety of factors, including expectations around inflation, the Fed's actions, and how investors reacted to it all, which nobody, they did not react well. The Fed raised the interest rates, and inflation is high. So not good sign for mortgages. Mortgage rates have jumped by nearly 3 percentage points since the start of 2022. And last week rose above 6% for a 30-year fixed rate mortgage for the first time since 2008. And that was according to Freddie Mac. The average rate for an identical loan was 2.86%. That was the same week in 2021. Other home loans are most closely tethered to the Fed's move. Home equity lines of credit, and adjustable rate mortgages, which could carry variable interest rates, generally rise within 2 billing cycles after a change in the Fed rates. Now, I was in a meeting with a lender yesterday who was telling us that it's not that the interest rates aren't going to jump that much, that the Fed raising the interest rates was already baked in to the interest rates that we're currently seeing right now. So there's not going to be an immediate jump up in the interest rates, not by at least a point or so. That won't happen. And just so that we're clear, He was estimating that by the end of 2023, the rates should start going down. So here's a quick discussion. Housing, the interest rates are going up, but so are housing values. So you're going to have to pay, if you wait for the interest rates to drop at the end of 2023 and the start of 2024, the cost of houses will have gone up, and will have gone up more than the interest rates at that period of time. So it's better net to buy the house now while the interest rate is where it is. Get into a house, live with that interest rate for a year and a half, 2 years, and then when the interest rates start coming down, refinance. That way, at least you're in the market and you're beginning to take advantage of owning a house. That is my suggestion, and I'm happy to help you. So, Fed raised interest rates. It's going to affect the mortgage a little bit, but not much. The mortgage rates. But like I said, if you want to get into a house, it's a good time to get into a house now. While the interest rates are where they are, they will continue to rise, but they will fall. They always do. And when they do, you can refinance and enjoy the new lower interest rates while you've been writing off the interest and writing off anything else that you can on that house. All right. Well, this is Jamie from Jamie Barber Homes saying aloha. It's Friday. And if you need to reach me, you can reach me at jamie@jamiebarberhomes.com. I'm happy to answer any of your questions, and I'm happy to help you buy and sell real estate, invest, whatever you use in your heart that has to do with real estate. I'm here to help. All right. Well, again, Jamie at Jamie Barber Homes, and aloha. It's Friday. Enjoy the weekend. Hopefully you don't have to work. Well, unless you're a real estate agent, you're in retail sales or hospitality. All right. It's Jamie Barber talking to you until next week. Bye-bye. Have a good weekend.